welcome you all, and we're grateful for you joining us today for our third quarter market update with Strategy Asset Managers, mixed messages in the path forward. My name's Greg Wirtz. I'm a director with Strategy Asset Managers, located in one of our 3 East Coast offices up in Westport, Connecticut. And today's platform will be moderated by our CEO, Tom Hewlett, who will be joined by Joe Traba and Alex Hagstrom, our 2 senior portfolio managers, who will discuss our outlook and kind of answer some questions. There's plenty out there that we may have in this environment and what they see not only into year end, but into next year. I would just ask and remind you to please keep yourselves on mute through the call. But there will be a Q&A session at the end of the call. And you'll see on the bottom of your screen, there's a chat box you could also use, or just unmute yourself at that point. So with that, Tom, I hand it over to our CEO, Tom Hewlett.
Appreciate that, Greg, and welcome everybody to our call today. And there are a lot of mixed messages that are being delivered, whether you're listening to it on the social media channels as well as going across the board with the major networks. And we're going to try to unwind some of that information for you today and give you some confidence going into the fourth quarter. The topics that we're going to cover today are the key economic indicators that we are seeing. We're also going to talk about what the major risks are ahead of us and what higher interest rates really mean and how long they are going to be there for us. Is the labor strike that we're experiencing right now out on the West Coast going to continue to impact us, and also the UAW strike, will these labor strikes impact the economy? We'll also touch base on government shutdowns. Alex has got some interesting facts about that. Is the dollar still king? And what's going on in China and the diminishing power there, and also our infrastructure super cycle that we're seeing. Right now, I'm going to introduce Joe Traba, our senior portfolio manager, and we will have a dialogue about all the things that are concerning us and what you should be aware of going forward. Joe?
Yeah, thank you, Tom. And again, thank you everyone for listening. As we've known, there are a lot of what we're hearing just with media out there on really focusing on some of the risks. So we hope to give you a little bit balanced view of what's occurring. And also, when we look forward, it's always important to know where we're at and where we came from. So when we look back at, last year, we had a market that was down severely, and we've got this big rally in the first half, which was led by a few stocks. Now, as we kind of look forward, we do have a little bit more of a mixed view, but it doesn't mean that the markets are going to head lower. We do think, again, there are some opportunities and some stocks that have not participated in the rally that we could start seeing a leveling off, and again, money rotate into some of those stocks. And I think what's important to remember, what's different from previous times when we've had these rate cycle periods, and also what have we seen with what opportunities are available for you. And I think one of the biggest asset class has been with higher interest rates. We've seen the US dollar strengthen, but also what does that mean for us? It means your money market with higher interest rates has a very attractive yield. So what we've previously seen with lower rates is the risk off and people went into more of the dividend paying stocks. But now with rates where they're at, that has been an attractive cycle and an investment that people have put money into. Now, again, as Tom mentioned, we do have a little bit more of a mixed economic data that's coming out, but we're also going to share with you some facts historically when we are at the end of a rate cycle, what ends up happening 12 months down the road. So a few things that we want people to know. Now, we have seen high frequency data that is slowing. And this really started at the end of August and into September, and so far just a couple of days in October. What does that mean? It just means the effects from higher interest rates, and also think of gasoline prices. They went above 90. That is a tax on every consumer, and that does increase spending for those types of goods. Now, the negative with that, when you have higher inflation, and what we're seeing now is people pulling back. And one of the buzzwords that we were hearing is revenge spending. And that was really, think of COVID and the people wanting to get out. They needed to get out and they spent. They savings accounts were dwindled down. We did see money go into credit cards. And now with where rates are at and inflation, it's a cooling off period. That revenge spending has slowed down. And we continue to see that, not just in some of the higher frequency data, that's for fast food, people spending money on that. That's come down. But two other, anecdotes that we've seen is credit cards. People are spending less on their credit card. And that kind of makes sense. Just think of servicing that. It used to be maybe 10, 12% people were paying on interest rates for the credit cards, and it's doubled. So you are paying more just to service or have access to that credit. So those are a few things that we are seeing the slowing coming down. And the consumer does have stress that we're definitely seeing. Now, what does this also mean for the risk off sentiment? Well, we've had a big rally in the first half, again, with some of these big stocks. And what we traditionally see is a little bit of profit taking. And again, right on cue, the second half of September, which is seasonally the weakest period of the year, was down. And we're seeing a little bit of that in October. But when we look at where the market's been from its high to its low, you traditionally have a 10% correction every 18 months. So again, we're right kind of on that support technically. We also know that the concentration risk, as we mentioned before, when you look at indices, is very high. So we always want to know what you own. So when people are looking at, the different benchmarks, know that some of these are very concentrated in a few stocks. So this doesn't mean that these stocks are going to go lower and have a big correction. It just means they may tread water and you see other parts of the market do better. As we go a little bit forward, one of the positives that we continue to see do well is when we look at employment. Employment has been extremely strong. We've seen a little bit of a slowdown recently on the week-to-week data, but you don't get significant downturns when you have full employment. And as Tom mentioned, we'll get into a little bit of the labor strikes. Now, we have seen, again, some of the big Hollywood out here in California, and again, UAW strikes more back east. And we do expect to see more. And again, it's a direct result of things costing more. And Kaiser Hospital, they're going on strike now. So we do expect to see that, again, as people want more wages. What we do also see is the power of AI being more of a tool. And we had mentioned this earlier. We're not afraid of AI, and we know technology moves forward. And what I mean by that, people were nervous about our calculator, that was going to make us, less intelligent. Well, we've known that's a tool, and we can see that with AI pretty clearly. And it was brought to our attention. You kind of think of a company that wanted to advertise would have to, one, hire not just the advertising agency, but you had to hire actors, you had to hire a production set, you had to find a location. All of these were added costs. And what can you do now? You can use AI. And again, with the help of people to help figure out what you want, it cuts the cost dramatically. So you think of a hairstylist that was doing the hair for the actors. Same thing with makeup. A lot of these jobs, I'm not going to say that they're going to go away, but it's going to be in less demand. There'll be other types of jobs that will be in demand. And that's, again, part of what we've spoken about is the reshoring of the United States of America, or if you want to call it the refriending. And what I mean by that, you've seen production for decades leave the United States. And what have we seen recently is jobs and production, manufacturing coming back to the United States. That's powerful. And that is not something short term. This is multi-years that it'll take if we keep growing at the clip we're growing at. And these require a different skill set for jobs. So we do think there is opportunity there, but people are going to have to learn a different skill set. These are some positives that are coming and are here now. So again, unemployment continues to remain low, and historically, you don't get significant disruptions or recessions when you have people working and people spending. What we do know, the Fed, as a direct result of the Fed raising rates, that's crimping what we're seeing now with not just inflation, but also people spending. And again, that's what they wanted to see happen. Their next kind of what the Fed outlined was to start saying unemployment tick higher. And we do think that's kind of the next, leg that we'll see. We also have to understand that the stock market is looking down the road. So we may hear further economic data that's not that good, but we might start seeing the stock market stabilize and start moving better. And the one thing that stock market likes, and all of us as well, you like certainty. And right now we have a batch of uncertain, not just data that's coming out, just unknowns. And we can look at that with the two things we've spoken about before, inflation, interest rates, but also with our government. And we'll go into a little bit more detail on all of those. But I do think, media, we've spoken about this before, their job is to sell and get people really hyped up on one way or the other. It's kind of boring to talk about, the mainstay, which is happening. So we do know a lot of the risks that are out there, but there are quite a few positives that people should be aware of. And again, one other thing that we looked at with the stock market, we know with this recent downturn and having 2 consecutive quarters of earnings not growing, and this is going over year, we do look forward. And again, not just the fourth quarter, which we're in now, but also next year. And this is important because earnings and valuations do matter. And that's where, again, we think the opportunity lies moving forward. Valuations outside of a few companies is at historic norms, and some things are even cheaper. Now, we also do see going forward earnings increasing double digits in 2024. So with a healthy data that we've seen from the economy, we are slowing. But again, there's a reason why the Fed raised rates so much, because we do have a strong economy. Now, we should start seeing some weakness there on the economic indicators that Tom was referring to. But again, one of the leading indicators is jobs, employment. And then you look at production as well. And those two areas remain pretty robust.
Yeah,
So-
Joe, let's talk a little bit about the economy right now and segue over to Alex. I don't think the economy is very weak at this point. I mean, you're seeing economic data that could propel us into a next cycle going forward. The markets should react to that soon, and maybe we are at the cusp of something great for 2024, although we've got a lot of headwinds. Alex, I want to transition over to you and have you talk a little bit about your insights into the government shutdown and the strong U.S. dollar in China also.
Yeah, absolutely. So, as most of you know, Congress did reach a deal to temporarily avert a government shutdown. It was a stopgap that will fund the government for 45 days until a more permanent agreement is negotiated. However, the ouster of Speaker of the House Kevin McCarthy does indicate that a shutdown remains a very strong possibility. However, the government's shut down 20 times since 1976. And while a shutdown is undoubtedly negative from an economic perspective, historically speaking, shutdowns have not had significant impacts on financial markets. In fact, the S&P 500 has actually risen 4.4% on average during these 20 government shutdowns. Of course, this doesn't mean a shutdown would be positive, but what it does mean is that in and of itself, this is unlikely to cause a market event, and it's not going to be the dominant factor determining where the market goes. You can also expect that the government will eventually reach a deal to fund itself, even if there is chaos on the path to that deal. And typically these shutdowns, they last around 8 days. We have seen them last up to a month in the past, but we can't expect that a deal will eventually be reached, as politicians are highly incentivized to keep the government funded. With that, one of the biggest stories has been the incredibly strong move in the dollar against other currencies. Now, we've been inundated for decades with these stories about the death of the dollar. The dollar is no longer going to be the reserve currency. Russia, China, they're going to start their own currency. Those narratives continue to be disproven as they have for decades. The dollar's been in a structural bull market since 2009, and it's likely that that structural bull market will continue. Yes, there are issues with the national debt, but what you have to remember is that China, Japan, and Europe are even more indebted than the US. In addition to that, they have severe demographic issues, which we do not have in the United States. Furthermore, the US is in the midst of a massive investment boom for manufacturing, artificial intelligence. Again, that's not something that's happening overseas. America remains the preeminent global power economically, militarily, technologically, legally, and China specifically, which is supposed to be our major rival, is facing extremely severe demographic issues as a consequence of the one-child policy, which they enacted many decades ago. In addition to that, they have serious issues in the real estate market. And overall, we can expect capital to continue to flow into the United States. And you can expect the dollar to continue to be the global reserve currency for years to come, for the foreseeable future.
Alex, let's talk a little bit about some of the rates that we're seeing right now. And Joe and you and I talk about moving clients into higher interest rate instruments. We all know about the U.S. Treasury and where that is. What about some of the other fixed income instruments that we're seeing?
Yeah, I mean, if Alex, you don't mind me going first.
No, go ahead.
One interesting point that we've seen, and this is recently, we talked about an inverted yield curve, but now we pretty much have a flat yield curve. And again, why is that? Well, like Alex mentioned, with the government shutdown, the Treasury, they had to issue close to $1 trillion in debt. This is really recently, and it really affects the longer duration bonds. So what we've seen is the yields have now come on par with the short duration. And again, it's supply demand in one aspect, meaning that we just issued a bunch of supply and we no longer have one of the biggest buyers of our debt, was ourselves. So that's because of quantitative tightening and again, raising rates. So that's where we're at now. 2 points to look at is historically, and you go back to 1984, we've had 6 rate hike cycles, and all but one of them, you look 12 months post that last rate hike, the markets are positive and on average double digits going out 12 months from that last rate hike. So it really points toward, yes, now you have a risk-off alternative with the money market yield Tom had mentioned, but longer term, we know stocks outperform inflation, and that's just how history works. So we do know short term, if you are looking to use funds, you do have an alternative. And that's one of the reasons why some of the traditional safe haven assets have not been that in the recent time period because, again, of the risk off. But longer term, history does tell us the stock market does outperform, especially when you're at the end of the rate hikes.
Joe, let's talk about the sectors that we've been repositioning clients into, and can we touch on that?
Yeah, so absolutely. So we know, again, it's 2 sectors that have led this market, and these are the 2 most beaten down sectors from last year: technology, and then some of the communication services. And they were down tremendously last year, and they've rebounded this year. Typically, what you have when the market's bottom is the things that have done the worst, they do well, but then you get a leveling off. So again, technology is here to stay, but there's going to be new leadership. And what we mean by that, it's money has rotated into these stocks, a little expensive. There's now other areas, and we have been mentioning some of the industrials, as you said, with production, manufacturing coming back to the U.S. I think of some of the electrical companies as we redo our power grid. These were companies that, again, longer term, this is where the government's putting money in, and we do see opportunity there. And also, when you look at AI, who is one of the biggest beneficiaries? it's our healthcare system as well. So we do think, that is one area that, again, is traditionally more of a safe haven as people continue to use medication. But with some of the new developments we've seen with medication, and Alex can talk about one of his drugs that we mentioned with weight loss and the effect that we've seen on that. So there are dislocations that we're going to see in the market, but it's also, there's going to be opportunities. And these are just some of the areas that we are repositioning. And again, we think with the friendshoring, and that's really manufacturing coming back to the U.S., it does benefit not just America, but also our borders. And that's with Mexico and also with Canada. So that's a shift from overseas with manufacturing in Asia to coming home or closer to home. Alex?
Yeah, and I think, many of you may have heard about Ozempic and other similar drugs in the news, but this is a weight loss drug, and people who take it basically lose 20 to 25% of their weight. It's incredible to see how technological progress solves problems, and a lot of people believed that the obesity issue in America was, intractable and unsolvable, and it's still very early in the history of these drugs, but it does look like, there may be a solution to this. And of course, that'll have knock-on effects. Obviously, as Americans become healthier, there should be beneficial effects throughout the economy from that.
Let's talk about some specific names that, we've invested in and done well, Joe, and where we see things fourth quarter and into 2024.
Yeah, so again, going into where the markets are at, we've had a pretty good rally in the first half. And again, what we're looking for is just a rotation. And what I mean by that, some of the stocks, and again, these are the top Apples and Microsofts, Google, that have done very well, just to take a breather. And you start seeing money rotate into other segments of the market. And again, I do think software, that's a big beneficiary of AI. It's not just individuals, it's companies that need to, do a better job of reinventing themselves. So I do think that type of positioning is going to do well. But we also do see, again, with the rebuilding of our infrastructure as a tremendous opportunity. And those are areas that are not just shorter term, it's a longer term. And again, that's a couple of the themes that we've positioned. And again, with medicine and just how we get medicine, I think that's always been a staple. And especially as the consumer gets a little bit more crimped with their discretionary spending, it does go back to staples on what they own. And the last point of that is, as we've seen higher price increases, especially if anyone goes shopping, do we ever see those prices go lower? No. What do? They shrink the package, so you're buying less of a good, but those prices remain high. And this is a fact because we've seen earnings, their margins are better. So they may not be selling more product, but their margins are getting better because their input costs have gone lower. Just something to keep in mind as we see higher prices for longer.
Alex, let's talk a little bit about some of the talking points that we've had in our meetings recently, and I'll just tee you up with the McDonald's reference that we discussed.
Yeah, absolutely. So one of the high frequency data points that we follow is traffic at McDonald's, and it's seen a very, very marked deceleration over the past few months. And I think one of the biggest drivers of that is the spread between the cost of eating at home and eating in restaurants. You probably noticed it yourself, but even a low quality fast food meal, seems to cost more than high quality food cooked at home. So I do think, restaurant prices will need to potentially deflate or disinflate to some extent in order to draw people back. And, Ozempic also relates to that. And the Walmart CEO, in fact, yeah, for sure. And the Walmart CEO just recently, he called out Ozempic. He said that they have already noticed people buying less junk food just off the few million people who are on it already. So this could be a very permanent shift away from a lot of the incredibly unhealthy, destructive foods that Americans eat far too much of.
And what's interesting with McDonald's, it's a franchise business, and their clients are people that own the McDonald's locations, and they raised their franchise fee by 1%. So again, it's this trend that we're talking about, and you keep an eye on these types of things as they move forward.
Well, there's definitely not I personally know a few people who have benefited from Ozempic, and it's changed their life. Diabetics, obese cases. It's not readily available for that at this point, but it is something that is probably going to be repurposed into that area to contribute to a healthier society. I mean, the health and wellness sector is growing enormously as we know it. Longevity, how are we going to improve our own lives? And we've seen incredible breakthroughs in medicine, robotics, the way that surgeries are performed, how AI is helping out. We had a conversation recently with a client who shared information about their condition, medical condition, a very serious medical condition. And right away, Joe, myself, and Alex were able to contribute some current information that changed an outlook and shifted them into another direction. And that is just because of the developments that have taken place in multiple areas of healthcare at this point. And it's revolutionary. And you've seen it. Probably you've even personally experienced it. Maybe you've gotten a knee replaced or shoulder surgery recently, or you had a heart procedure, or you had a diagnosis that at one point was not very promising, and now there is something that can contribute to the success of managing it or even reversing it. These are things that we're seeing right now, and Strategy Asset Managers does a very good job at identifying the individual names as well as sectors that we can manage portfolios to. So it's Joe wants to say something. I can see.
Yes, yeah. I mean, it's really the power of our network. A lot of us know us as a money manager, and we're top money manager at that. But it's who we deal with. I mean, our clients are our family, and one of the great things with Tom is that he has a great network, and when something comes up, ask us. We have people that are specialists in different areas that can help. And one of the big things, Tom and I, doing multiple Ironmen, we're not afraid to do the work. And part of that also is looking forward. Our mind is a powerful mechanism, and having positive momentum.
A positive mindset. It's hard. Sometimes you get distracted and you get overwhelmed. And talking to people about it, especially in our group on the research side of things, when we collaborate, we can generate more ideas.
And it's just seeing something as simple as seeing something from a different lens, a different point of view.
Correct.
And that's one of the great things that we do is we all have diverse opinions. And I always say that the best decisions are made by the most diverse group of people that are allowed to, say what's on their mind. Because you just see things from a different lens. And I think that's critical, especially now when there's just one predominant view of the negative that's coming out there where things are going. And again, you need to balance that out. We always talk about if you're going to watch TV, make sure you watch, if you're going to watch Fox, then you have to watch CNBC. Just having a little bit of balance.
Sure. Joe, we've got to talk about where we're going to go from here, and kind of the concluding remarks. So I'll turn that over to you.
Yeah, like we said, expect some turbulence in the short term. Volatilities come back again as the uncertainties of the trajectory of interest rates and inflation. But we do, again, look forward when these unknowns are known, and we are seeing interest rates we think will start cooling off, and we may be at the peak already. And why we say that? Well, gasoline had one of its sharpest declines in over 35, 40 years. And that was just a couple days ago.
Not in California.
Yeah.
And don't move to California.
California gas prices were higher than they were in Hawaii. So we were approaching $8. So that's kind of cooled off. So we expect that to, continue because it's a tax on everyone. But the other one is, and one of the high frequency data, is people using their credit card. That's dropped 11%. This is very short-term data that we're seeing. So we are seeing the consumer pull back. And again,
Do you think that that's because the consumer is maxed out?
Well, it gets the lower
maxed out on their debt.
I just look at how you're going to spend your money. Before, you were spending it on discretionary, and that was the revenge spending we talked about. You were going to get out. You were going to go see a show. I think it's now kind of cycling to more of the durables. These are the staples that you need. And sure, you're still going to have people that want to get out for the experience. You can look at any concert or football game. So it's just shifting.
Yeah, I don't want to digress to that area. So you think the markets are going to take a breather?
I think they are. We're seeing that right now. Now, why am I not more pessimistic and thinking that we're going to see a 2008 meltdown? That's a good question, but I'll give you some answers. When you look at dislocations in the market, and that means if you go back to 2008, any of these meltdowns, you did not have price discovery, meaning if you were trying to sell a specific investment, it kind of went into this oblivion. You weren't getting accurate pricing, especially on derivatives. This market has acted extremely calm. You've had a perfect market, meaning there's been zero disruption. So I don't see any of that occurring now. And yes, lending's gotten tighter, but it just means you have traditional ways of borrowing. So anytime that you have these big crises, lending freezes up and there's no lending going on. We still are seeing it. It may not be through the traditional banks, but it's still occurring. So I think those two things, along with full employment, doesn't get me as negative as what other people are hearing. You do have to focus in on that.
Yeah, Alex, do you have a comment on that?
Yeah, I mean, there's always going to be cyclical ups and downs in the markets and the economy, but I think the long-term secular outlook, fueled by AI robotics and the integration of AI and robotics, remains extremely bright.
Yeah, we've seen a lot of private equity deals coming up, and that's because there's a lot of cash on the sidelines with these private equity firms and not enough deals to chase after. And that to me signals that there is another cycle happening, and some of the smarter money is going after the private sectors that are there that will contribute to the success of some of the publicly traded companies that we own. Joe, you want to talk about that a little bit?
Yeah, and that's a great point, because what we touched on briefly was bankruptcies. And the headline of a company going bankrupt like Bed Bath & Beyond and potentially WeWorks or Rite Aid, that sounds extremely negative. But when you kind of think about this, these companies probably, maybe we thought they already weren't bankrupt. But what happens with the cycle? You take companies that were not profitable, for lowering prices, you're removing them from the equation, and you're getting the other companies to take over that demand, and they're going to be healthier and they can raise price. So that's the cycle that Tom's referring to, is when you do see bankruptcies, don't be afraid of it. Look at what sectors are going to benefit. It's just, it takes a little bit of time for that to play its way through. But we know the government is not going to support these companies like they did just a couple of years ago. And that does give us a better view longer term.
Okay. Well, Joe and Alex, do you have any other concluding remarks before we sum everything up?
Just my last one, it's just thinking down the road and what we're seeing for not just this year, which is, again, really 2 more months. But we do expect significant industry rotation. And that's just the economy transitioning to, better than expected growth when we get into next year. With, again, inflation remaining, high, and the same thing with interest rates. But we do see moderate global growth recovery, and I think that's going to benefit, not just you, but our strategies as well.
We need to worry about political infighting in Congress and the Biden administration, the potential administration change in the future, and all the political noise that's out there?
I'm laughing because this seems to be every year we get asked this question. And what do we always say? Focus on policy, not politics.
Good point. Very good. Focus on the policy and not the politics that's there.
And we do know with one last point, Tom, if it's okay.
Yeah.
The last point is we do know with a higher deficit, there's two ways to really solve this. It's cut back on spending or you raise taxes. Nothing's changed in that point of view. So I do think as next year heats up with more politics being involved, really, pay attention to what's going to happen with taxes.
Yeah, pay attention to taxes because you've got the October 15th deadline coming up, especially in California for those people that were given a pass on paying their taxes on April 15th. So that's a reminder. Also, this is the time to get a checkup on the end of the year outlook for your accounts. So make sure you're in touch with your advisor, getting the second opinion on where things are heading. And if we can assist in any way, feel free to reach out to us and we'll contribute and also support the end of the year outlook for you. And Alex, do you have anything to add to conclude?
Just that, politics has always been a mess. Politicians have always been the same. If you went back 2,000 years, you'd probably find the same types of people and the same types of conflicts happening politically. But thankfully, politicians are not what drive the economy upwards. Thankfully, it is private sector technological innovation. So, don't look too closely inside the sausage factory, but it's always been this way.
Great visual, Alex. Thank you.
And also just one last point, with the end of the year, we have required minimum distributions. And for some clients that might have been at TD that are now at Schwab, just want to make sure if you have any questions, feel free to reach out to us or your advisor.
Yeah, there are lots of housekeeping items that the advisors and the wealth management firms need to be on top of. And for those of you who are on the calls, just paying attention to getting out in front of this well in advance rather than waiting to the last minute and then doing tweaks to your own financial plan or financial planning exercises for the next year. That's all very, very important. Contact your advisor. And seek out that wellness call that we all want to make sure that we're in the right area. Okay, that's my signal that we need to conclude the call. Joe, Alex, I think we've said enough. We want to thank everybody for joining us today on the Strategy Asset Managers Market Outlook call.